Nobody coming. No one here. Oh, anyway, one here. So I think the timing important. Like just now timing is 11 over there are people. Now is the timing less people. So nobody take P7 in hospital. Hi, good afternoon. I'm Daniel. Welcome to this P7 masterclass. So we target to go through some questions in about 2 hours. So first of all, P7 exam structure. P7 examination team has been pretty stable. I was in London in April this year. I met with the examination team. Because of the 4 examinations, the examination team has been expanded. They used to have an examiner and an assessor, 2 of them, and so now they have a team of 2. So sometimes we do see some question a little bit inconsistent with the previous episode. Was the reason the new examination team added to with new members. So one of them I believe is involved in the FA exam question setting. So if you see the exam question like inventory cost or payroll, usually this means the person has been from the FA team. If not, the P7 team is usually concentrating on the more complex accounting issue in P2, like impairment, non-current asset held for sale. Now, nevertheless, let me first begin by looking at the exam structure. Now, the exam structure has no change. Section A, total 60 marks. The largest question is question 1, 35 marks. But the 35 marks here, 4 marks are for professional marks and 31 marks are from the technical content. These 4 marks professional marks require you to present your answer in the format of briefing notes, and the briefing note format is pretty easy to score full mark. So I have a template in the note next page. I'll show you. Question 1 is also predictable because the majority, about 20 marks of the question, will be on risk question, and question 1 is about audit planning. So some of those could be related to planning, like why do we do analytical procedures, and sometimes we have a little bit of questions on what are the audit procedures to be performed. So it is focusing on the planning stage. Question 2 is mandatory, 25 marks. So sometimes examiner use it for the non-audit, sometimes the examiner use it for method to consider, evidence expected. I'll show you what they are later on. Now the section B, there are 3 questions. We need to answer 2 of them. Question 3, 4, 5. And one of the questions usually is for ethics, professional ethics, quality control, quality issues. And question 5 is always reserved for audit reports, although there are some current issue question. So there is one current issue that we need to pay attention to. I'll tell you later on about this. So first, question 1. Question 1, about 18 to 20 mark is risk question. Now there are 3 types of risk question in P7. So at the planning stage, auditor need to assess audit risk. So the question will ask you to identify, evaluate the audit risk. But audit risk is made up of risk of material misstatement. So sometimes the question, instead of asking you about audit risk, ask about risk of material misstatements. And sometimes the question is about business risk. Now the difference is business risk, the exam answer need to be written in terms of business impact on the business. So for example, reputation damage to the company, causing financial loss to the company, that will be business impact. So it's written more from the management perspective. But RMM, risk of material misstatement, and audit risk, we need to write the impact of the risk on the audit on the financial statement. The financial statements are wrong and auditor couldn't detect, therefore gave the wrong opinion. So RMM and audit risk, the focus is the impact on the financial statements. So question 1, Because of this has about 18 to 20 marks. As I mentioned, we need to prepare the answer in a briefing note format, 4 marks. So that will make up about 24 marks of the 35 mark question. So the rest can either come from audit procedures. Now audit procedures usually maybe about 2 areas, like an impairment 1 area, the government run area. So each one about 4 marks. And sometimes there are some ethic questions as well in question 1. So this made up of the 35 marks. Now, so the only thing very predictable is the risk. Okay. So later on I'll tell you what to expect in the coming exam in terms of risk question. Question 2 usually is non-audit, but non-audit sometimes appear in section B. So if it appears in section B, then question 2 usually is what we call the matter to consider and evidence expected type of question. I have one positive question to go through later on to illustrate the concept over here. Now for the non-audit services, question 2, 25 marks. It can be forensic investigation, performance report, KPI report audit, prospective financial information, which is a forecast, like cash flow forecast P&L, assurance, due diligence. Once in a while we have a review engagement, how to review the interim financial report. But the most important 3 is this 3. These 3 usually the case study are bigger, attract more marks. Forensic investigation usually is about there's a fraud and how do we, for example, confirm who committed the fraud, how do we quantify the loss. So the procedure are similar to audit procedures, but the questions are not attracting a lot of marks nowadays. So it's about 5 marks question. So the biggest are these 3. Now question 4 usually is about ethics, quality and money laundering, sometimes professional issue. And then lastly, question 5 is audit report and current issue. Now if there's current issue will appear in question 5A, and then the audit report will appear in question 5B. But current issue is based on article written by examiner. Okay, so this is based on examiner's technical article. So therefore, in October 2017, the examiner uploaded on the website, ACCA website, a new technical article. This is about ISA 450, evaluate misstatements. So this part talks about the different type of misstatement. What must auditor do about misstatements? So please download this article and read the article. So it is likely to come out in question 5A as a theory question. This examiner has a track record. The article that is just published usually will come out in the examination. So then there's an older article just before this. Is an article called NOCLA. So it stands for non-compliance with law and regulation. Now this article came out a bit older than the October 2017, but it doesn't appear to have been examined, so it might be possible also as a technical question, right? So therefore, please download these 2 articles and read them. If it come out, it will be question 5A. But question 5B, therefore, is always about audit report. So there's always a case study and talk about the different type of audit report. So later on, I'll come to the audit report question or illustrate the concept. So that's the examination format. Now we have what came out in September 2017 exam. Question 1 was based on a luxury hotel. Now this question wasn't published, so this information is gathered from 2 sources. Number 1, from the examiner's report, and the examiner mentioned something about the exam. The other is from my students who attended this exam question, based on what they can remember and what they told me. So what came out in question 1 was business risk and risk of material misstatement in the case study. So altogether 20 marks. So therefore, this coming exam, we need to pay more attention to audit risk. Okay? And there are one audit procedure question about the legal claim from an environmental group, 5 marks. So it is like a auditing procedure on provision for legal claim. Okay? Then question 2 was the matter to consider an evidence expected question. So these are quite accounting related. So we have number 1, there's a provision for decommissioning costs. They change the assumption. So how do we audit the assumption? Consider the impact or change in the assumption. Second, they change the useful life of the fixed asset. And then third, there's something wrong with the provision for bad debt and receivable. So you can see 10, 7, 8, this gave us the 25 marks. So the coming exam, provision for decommissioning, useful life change and receivable, therefore will be less important. Now question 3, the non-audit services, what came out was the due diligence question. So we are supposed to talk about some of the due diligence issue, like the revenue, losing revenue. So how does it affect the due diligence? Why is it important to highlight this to the acquisition company, the acquiring company? And there was some land. Now they discover the land has restriction in use. So how does it affect the acquisition? So this is the altogether 12 marks. So remember, question 3 should be 20 marks. So there are another 8 marks coming from ethics. So professional ethics, independence. Now the next one, question 4 was ethics and professional issues. So again, we have some sort of a self-review track coming out in due diligence review. We also have the partner in charge of audit for more than 7 years, need rotation. But this question is the client refused to allow the rotation. They want the same partner to retain. So what is the ethical issue over here? So you need to talk about, if we do that, then we are exposed to familiarity threat. At the same time, we don't comply with the code. But if we don't do that, then what can we do? We have to tell the client we can't do it, and we need to be pre-prepared that they will change auditor. They threaten to change auditor. So you need to identify the second threat called intimidation threat. So that was what came out in September 2017. Question 5, as I mentioned, is always audit report. And we have a going concern issue in the case study. And therefore, and the examiner give you a draft audit report, certain paragraph, and ask us to criticize it. So later on, I'll show you how to answer this kind of question. So this is what came out in the September 2017. So from here we know the risk question is the most important topic in P7 exam. 2 reasons. Number 1 is in question 1, mandatory. Number 2, it's about 20 marks. So if you can tackle this plus a format, 4 marks, it's about 24 marks. And so we need to make sure our answer for this question is high quality. Now, so as I mentioned, the risk can be divided into 3 types. So what you saw came out was business risk and RMM. So we focus on the audit risk, although audit risk and RMM are similar. Okay? Now, audit risk compared to RMM, the only thing extra is audit risk include detection risk, and risk of material misstatement does not include detection risk. So audit risk question, actually our answer can be wider in scope. Okay? Because you can talk about, for example, we are appointed as auditor for the first year, so the detection risk is a bit higher. So that's available in audit risk, not available in RMM. Okay? So this is the past year analysis. Anyway, I've already told you what came out in September 2017. So now remember, question 1 always need to be presented in the briefing note format. So, and then it is always prepared by the manager, either for the partner or for the team. So there's a fixed format to go through, and the format will give you 4 marks. So in the next page, you can see this is the format. So there's a title called briefing note, and then it must be always from the audit manager. So the case study asks you to write for the partner, then you write to the partner. Now there must be a subject matter, and because question 1 is always audit risk, audit planning, so the subject heading is always audit planning issue. Then you just insert the client's name, maybe even the accounting year over here. That's the subject matter. Now, the briefing note always need to have an introduction paragraph. This introduction paragraph must explain the purpose of the briefing note. So you need to say this briefing note include what? So you include the requirements from the question. Okay? So you include, for example, the evaluation of audit risk and the procedure to be performed to confirm goodwill. So you need to write the requirements over here. So once you are able to write the introduction, then you start writing your answer for part A. So therefore, you might put a heading here called audit risk. Then write your answer here. After that, then you write a heading for part B, like audit procedures on goodwill. Then after that, the briefing note must end with a conclusion. So once you are able to do that, you get the 4 marks. And the conclusion is always, the notes have done its purpose, and these are the main issue in the audit. Just write the name of it. Okay? Then the 4 format marks will be quite easy to obtain. So please follow this format. Now, so as I mentioned, audit risk and RMM are very similar, just that audit risk is RMM plus detection risk. Okay? Now, so RMM here, most of the answer need you to use accounting standard. So it is about the risk that they don't follow IFRS, IAS. So it's important for us to be able to write in the exam answer the accounting standard number, the accounting standard title, and the relevant principle. But just memorizing and printing them in the note doesn't help. You need to say which part of this could be breached based on the information from the case study. So that's why you see next part of my note is to give you a summary of those accounting standards that are usually used in P7. And this is used in question 1, audit risk question, RMN question. It is used in question relating to matter to consider. Matter to consider, you still need to quote accounting standard, and it is used again in audit report. In audit report, you have to say that this is a misstatement because they didn't comply with the standard, and which standard they didn't comply. So one of the most important skill in P7 to beef up your answer is accounting knowledge. Accounting standard number, accounting standard title, and the accounting standard key principle. Now, RMM include management bias. P7 examiner use the term bias, means they are subjective when they prepare financial statement. So it's relating to any pressure. Any pressure that they face is creating management bias. So it can be the company need loan. Okay? It can be they are going to be listed. It can be now they are listed, so therefore they need to meet expectation. Okay? It can be also they are selling part of the business. So example, a subsidiary or even part of a subsidiary. So they need to fetch a good price, so it can create management bias. So this is part of your answer as audit risk. Okay? You can say that this will then have a risk that asset overstates asset, revenue, profit, and understate expense and liabilities. Okay. Now to score high mark, the examiner expect you to use information from the case that they need a loan, then bring out the issue called management bias, and you will also state which account therefore is at risk, like asset, and what is the direction of the risk overstatement. So that is the kind of detail that need to be written to score mark. So that's called the management bias. Now, and RMM audit risk include control risk. So internal control that is not working very well. So for example, it can be the company lack a financial director who left and nobody supervised the accounting department. So this can be into the answer, okay, included in the answer. Now, audit risk include detection risk. RMM doesn't include, and detection risk come from auditing a new audit client. It comes from the auditor is facing a very tight audit deadline, or the team that has been assigned is very inexperienced, or it can be the way we conduct our audit, the quality of evidence is not very strong, like the sample size is being too small. So all this contribute to detection risk. Now, so what you see in next page onwards, page 6 onwards, until page 13. These are the accounting standards. No, not 13. Let's see. Page 14. Yes. So until page 14, these are the accounting standards that we need to use to help us to answer P7 exam question. So as I said, you need to be able to quote the number, the key principle, and then talk about how does it cause the financial statement to be wrong, which is the RMM and the audit risk. So it's organized in the table format to make it easier for you to use in examination. Now, so I'm going to illustrate using one or two of them, so that the rest you'll be able to spend time reading on your own. So let me illustrate using this one over here. I'm going to use two to illustrate. First one is the IAS 16. The cost of PPE include the initial estimates of the decommissioning costs. So you notice this came out in the September 2017 exam question. So the accounting standard says that so IAS 16, the title property, plant and equipment, in terms of decommissioning costs, this is the principle. Cost of PPE should include decommissioning costs if there's an obligation to dismantle the PPE at the end of the useful life. So this obligation can be a legal obligation. So example, it can be a regulation, it can be a contract, but it can also be something what we call the constructive obligation. So therefore, the company publicly stated they will dismantle the asset. So they created the commitment. So this is the obligation. So if this obligation exists, they need to recognize the decommissioning cost. So they need to debit PPE, and they need to credit something called the provision for decommissioning. Right. Now, so here, this part here must be based on the present value of future cash flow. So we have to estimate this first, then we can create the number to do the double entry to recognize this. So when we talk about RMM audit risk, the examiner expects us to talk about maybe this part is done wrongly. So when it is done wrongly, there are situation number one, they omitted. So they forget to include this cost. So this is the one possible risk. But you need to look at the case study, whether they did mention they recorded a provision. If they did, you can't use it. But the case study is if the case study is silent in this area, then we can say that one risk is they are forgotten. But we have a second risk is, for example, they are not discounted. So they have included the next 10 year, what will need to incur in 10 years time to dismantle, but they forget to discount. So if they forget to discount, then you have to say different impact. The first impact is actually understate. So the examiner expect you to go to the extent to talk about which account and which direction is the misstatement. Okay? Overstate, understate. Now if it's not discounted, then you say that it will be overstating the PPE and overstating the provision. Now then there's another third possible audit risk, RMM, which is the wrong discount rate. So the discount rate is inappropriate. As a result, the number calculated are wrong. Then here you can write both direction. It can be overstated or it can be understated. So that's why you have to look at the case study. So the examiner comment, student who just memorize note and print all three will not get high mark because they will mark it as if you never read the case. So you need to demonstrate to the examiner the case that have been read and therefore apply the correct scenario, either 1, 2 or 3 into the case study. Right? So this is how this set of notes should be used to help you. Okay. So I demonstrated one. So these are written in the note for you already in the proper sentences. You can see here it is not included. Then you understate PPE, understate liability, or it is included but it is not discounted. Okay. Then this will overstate PPE, overstate liability, or it is not using the correct rate. Now the other thing we need to be careful with PPE decommissioning is we are predicting 10 years number. So as 1 year passed, we are now predicting the 9 years number. So the same number discounting over 10 years, discounting over 9 years should change. So the provision will change. Okay? So the provision will change because of the unwinding of finance costs. Okay? So if you don't change, then the provision will be understated because as you discount over shorter period, the provision should increase. So this will be the kind of impact you need to be able to write in exam answer. So that's an illustration of decommissioning cost. Now I'm going to illustrate using another one. Here, IFRS 5, non-current asset held for register, held for sale. Now, so the accounting standard actually say for the current or for the fixed asset to be classified as held for sale, it should meet the following conditions. So the following conditions should be met. Number 1, management is committed to sell. It is available for immediate sale, and they must have started a program to sell, and the selling price is reasonable. Therefore, the sales is likely to occur within a year. So this is the accounting standard we need to use. So the risk is they met the criteria. So the fixed asset met the criteria, should be reclassified as held for sale, but they did not. So therefore, it is not reclassified as held for sale. Then you need to say then we overstate current asset. Now when we call it held for sale is current asset, we don't depreciate. So if we didn't do it, we continue to depreciate. So we will overstate the non-current asset, overstate depreciation, and we understate current asset. Okay. So this is the recognition criteria, but then we have the measurement criteria. If this is classified as held for sale, it is called current asset, and depreciation should stop. But there's another one called measurement, which is the fixed asset, the held for sale asset must be based on lower of book value and fair value less cost to sell. So we need to write down and recognize impairment loss. So they should do it. So another risk is they have classified correctly, but the measurement is wrong. So therefore, they do not do the remeasurement. So as a result, we will understate, for example, the depreciation. Okay, right? So things like that need to be used in exam. Now, so I illustrated 2. So the rest, please go through that himself so that you can learn how to use this in exam. Now, those are relating to accounting standards. But audit risk and RMM include things that are not related to accounting standard. For example, management bias. So just as I mentioned already, they may therefore become subjective. So it can, when you see this in the case study, you highlight there's a management bias risk. Number one, the bonus of the management is based on profits. Okay? So therefore, they will likely to be overstating income, understating expenses. Or, so you say therefore, they want to maximize profit to get the bonus. That's why they may do this kind of accounting. Now, if the case study mentioned there's no finance director towards the year end, then you can say that the inherent risk and the control risk both increase. Now, which part is affected? First part, the accounting policy side. Now, finance director will not be involved in the low-level double entry, but will be involved in high-level accounting policy, accounting estimate. So these are the likely areas that could be at risk now, so you can highlight that. Next one is finance director is managerial staff, so there is a role called managerial supervision. So in this case, the finance director itself is an internal control. So a lack of a finance director means the lack of supervisory control. That's why control risk increase. So you need to explain like this in the exam to score mark. Now the next example is there's a new IT system introduced. They need to transfer data from the old to the new, and the transfer is wrong. So we end up with data transfer error, or the new system, the control are not very effective. It become a control risk. So these are the risks we use in exam question. Okay. Now, so those are RMM, accounting risk, management risk, and control risk. So now we look at the next one. These are called other audit risks. These are actually detection risks. So it's not RMM. So if the exam question asks for risk or material misstatement, you cannot write this in. But if the exam question asks for detection risk, this can be in. So first, new audit client. Now, if you just write the audit risk is that this is a new audit client like this, most likely you get just about half a mark. The risk question can be up to 1.5 mark to 2 marks. So you are losing a lot of marks just by writing this. So you need to talk about how does it contribute to audit risk, detection risk. So we need to say that because this is the new client, we lack cumulative knowledge of the client. So therefore, this will increase our detection risk. Now this risk can be reduced by thorough planning, spending more time to understand the business. Now, but in P7, new client comes with another risk called opening balances. So again, the examiner expects you to write this, say that this is audited by previous auditor, not by us. So they may contain misstatement. So this risk can also be reduced. How do we reduce it? We try to arrange to review the previous auditor working paper and then assess whether we need to do any additional procedure to confirm the opening balances ourselves. Okay? So that will be the detection risk relating to new client. So you notice the answer expect you to write a lot, which is in that sense reasonable. You need to be able to write this. The next one is detection risk relating to type audit deadline. So when you write this in the answer, it's only half a mark. So the audit risk increase along with me. So the spaces are left there for that purpose. So now question 1 always come in the form of email from the partner to the manager. So first paragraph, always take note of the year end. In P7, some of the issue in the case study is current year transaction. Some of them can be prior, so that need to brought forward to this year. Could be post balance sheet event. So it's important to look at the date in the case study and always compare to year end. Now the next one, you are assigned to the audit called ZCG, that is a listed company. Now in risk question, wherever you see the client is listed company, you just take note. You may not write them in the answer, but you take note the risk that come with this straight away. And if later on the examiner give you more information, you must apply them as risk. So listed company, there is always the management pressure. So bias. They need to meet the shareholder analyst expectation. So that could be one of them. And there are 2 accounting standards that are only required to be implemented by listed company, only listed company to apply them. One of them is the IAS 33 earning per share. And the other one is the IFRS 8 operating segments. Now, so take note of that, but don't write that as a risk first. Because if you just write like that, just because they are listed company, then they will definitely do this wrongly, is not the P7 kind of skill. The examiner is hoping that later on in the case study, if you see something about segment reporting, and you see the segment reporting may be wrong, then you can highlight segment reporting. So just need to be alert, right? Okay. Then we see the case study, how to use it later on. Now, so the next part tell us that this company is the largest telecommunication provider in the industry, and they expand internationally. They provide broadband and fixed telephone line services. So that's the nature of business. Now we look at the email. Now we need to identify the exam requirement by reading the email. So here we are now doing the planning. This is one of our largest audit client. So the partner say, I met with the group finance director yesterday. So below are the meeting notes. Now this is important. This is a meeting notes. What it means is that these are the information the finance director told the partner. Now what the finance director told the partner may or may not be true. So we need to use it for planning purpose. So please do not mistake that this is the fact. It may not be the truth, okay? But it's used for planning. So next, we also have the latest management account. Now wherever the examiner gives you latest management account, she expects you to use the number in the assessment of risk. It can be used to talk about materiality, but I can talk about risk as well. So I'll show you later on. The next sentence, we have also discussed the possibility of using the group internal audit to improve audit efficiency. I provided you with an extract from the latest report. So you are also given the report from the internal audit. So again, examiner expect you to use the information from this internal audit report. That's why she say use all the information provided. So evaluate audit risk. Now you notice evaluate, therefore examiner expect you to explain the risk and talk about this is a significant risk or not. That's called evaluate. There are 14 marks. Now so usually I target about 1.5 marks per risk. So we should talk about 8 to 9 risks, okay, from the case. But the examiner also give us marks for talking about materiality and trend. So therefore, if you mention about materiality of the transaction, you are given mark, calculate correctly. So it can be a 1 mark each. But examiner put a cap on the mark that can be given for materiality calculation. So we cannot identify 8 materiality and hope to get 8 marks. Therefore you pass the question already. No. So there's a cap. So the cap is 2 marks. Okay. Then trend. Calculating the trend to analyze audit risk essentially is changes from last year, significant fluctuation, significant or unusual fluctuation. So this changes from last year, that's a bit funny. So this is also 1 mark. But again, there's a cap. So a cap about 2 marks. So have 2 marks. Now and then for each audit risk, is between 1.5 to 2 marks. So if you are able to calculate 2 materiality, you get about 12 marks, 2 marks. So you left about 12. You calculate 1 or 2 trend, then you left about 10. So if it's 1.5 mark, then if you write about 7 audit risk, you'll be able to get you to pass. Right? So roughly, this is the scope that we need to write in the exam question. Right. So now we're going to start looking at the information to identify first the audit risk. Now you'll notice the question is audit risk, so it can be including detection risk. But this is not a new client, and we haven't been given anything about the tight deadline. So look at the notes from a meeting with a finance director. So I'll copy this out, and then I can show you how to identify them. Okay, now one of the company's strategic aim is to expand internationally. They go by acquiring, acquisition, or they go by buying license to operate in foreign country. So in March 2016, now in P7 it's always important to compare to year end. So that we know whether this is last year transaction or this year transaction. So the year end is 31st December 2016. So therefore this is during the year and it's a first Q of the year, first quarter, Q1. They bought a 50% equity interest in Wireless Telecom Company, WTC, a company operating in several countries where ZCG had previously no interest. The 50% is held by Wolf. The other 50% is held by Wolf. And the cost of 50% equity was 45 million. And they plan to account for this as a joint venture in the group financial statement. So, therefore, the first thing you should write is this material? Okay? Because material and the number is given is big, it allows you to get 1 mark to talk about it. So how to calculate material is like this. If this is an asset, we divide by total asset. So if you look at the case, the examiner gives us the management account. So the management account has the asset number. So you can see this is the total asset number. Now I'd like you to take a note. The year end is December. So this is last year December number, but this year is not December. So the management account we are given is actually 8 months number. Now, so the examiner purposely put this in to create additional complexity for you, to make your question more difficult. So when you use a number, you must take note of the date. For P&L, 8 months, we cannot compare 8 months profit and loss figure with 12 months. We are not comparing apple to apple. So for P&L, we have to do use an 8 month to do a 12-month projection. But for balance sheet, you don't do 8 month over 12-month projection. You just take the number. Okay? So the total asset is 598. So is this material? Let's go for 1 mark. So we need to take the 45 divided by 598. And we should get about 7.5% or TA for the asset. Now the threshold used by your P7 examiner is this. If it's bigger than 1% of TA, then it's material. Okay? It's less than 1% of TA is not material. Now we don't divide that by profit because this number is a balance sheet number. So for balance sheet number, P7 examiner is very strict. You need to compare to total asset. Okay. Now, so but again, when you conclude, you must conclude properly. This is a balance sheet number, is material. Then you need to say that this is material to the statement of financial position. Okay. SIP. do not use any other number to calculate, and don't talk about the impact on profit, because this is a balance sheet item. So that's the level of precision the P7 examiner expect in your answer. Alright, now next is, therefore, think about, this is a new transaction, they need to account for it. Audit risk RMM is they account for it wrongly. That's why the financial statements are wrong. So therefore, what is the relevant accounting standard? They want to account for it as a joint venture. So you need to talk about IFRS 11, joint arrangement. Then you need to mention, to be considered as joint venture, we need to consider whether there is joint control. So the risk is there's no joint control. Then we call that wrongly classified. As joint venture. So therefore, the classification is wrong. Now, please do not talk about measurement here. The reason is quite simple. Because if it's not joint venture, then it may be an associate. But associate accounting and joint venture accounting is both using the equity method of accounting. So the measurement will be similar, except the percentage is different. So the real risk here is the wrong classification. So in the balance sheet, it becomes misleading, right? So we talk about this as the risk. So you notice you need accounting standard knowledge to talk about risk. So this is the first one. Now we look at the next paragraph in the case study. 1st of January, as I said, if you pay attention to the date, then you discover this is the prior transaction, not the current year transaction. First of January, the year end is December 2016. So this is 2015. So this is called the beginning of last year. So the beginning of last year, they acquired a license to operate in Farland. So we do not need to audit the license because it should have been audited last year. So that's not the issue about whether the license accounting is correct. We should have checked the license accounting is correct or not last year already. So they affect the way we answer question. So they purchased a license to operate in Farland, rapidly expanding economy at the cost of 65 million. So again, here is useful for is it material. So remember, the cap is about 2 marks. So you need to do about 2. Okay? The license lasts for 10 years. Now this is not the useful life or remaining useful life, is the license period from the date it was purchased. So you can see from 1st of Jan, it will last for 10 years. Since purchasing the license, ZCG has established its network coverage in Farland, and the network become operational on 1st of July 2016. Now what it means is that they are ready to launch only on 1st of July 2016. So if you compare the two dates, okay, so therefore 1st Jan 2015 to 1st July 2016 is 1.5 years past already. So the license was recognized as an intangible asset at cost, at 31st December. So look at the date again. You can see the date is 31st December 2005. So this is the this year beginning balance. So it tells you it at cost. So it's still at 35. That means they have not done any amortization. Okay, no amortization. So up to here, what we need to say that is the correct accounting. Now 65 million, we talk about it, is it material, by dividing that with the total asset. Okay? So we can talk about the total asset number. Just now we have the total asset number. Okay, let me recall it. 598. So you calculate, but you know that it will be material. So you say this is material to S&P, right? But the issue is more about this year because we have audited the cost last year. Now, so based on the standard, the amortization is 10 years, over 10 years. Now, and it should be straight line for intangible asset. But which day they should start amortizing? So it should be the day when they are ready to use the asset. So it is the 1st of July. So you can see there's a 10-year useful life. 10 years. 1.5 years have passed. So therefore we left with 8.5 years. 8.5. So the amortization over 10 years useful life is wrong. It should be now over 8.5. Because the useful life is 8.5. The license period is 10. 1.5 is gone. So we need to do that. Amortization over 8.5 years. So if you take the 65 million over the 8.5, and they start from 1st of July, so year end December. So this year amortization should be 6 months. So we take the number, divide by 8.5, then we need to multiply by 6 months out of 12. This is the expected amortization charge. So it should be about 3.8 million. So then you need to talk about, is this material? Now here, the amortization will have to debit P&L and then credit accumulated amortization. So we need to then divide by profits and divide by total asset to say whether it is material. Now for the especially this part profit, because this one debit P&L. Okay. Now so this is when the examiner start to deduct mark from student who are not paying attention to the details given in the case. So you can see here we are not given profit, we are given revenue. So we have no choice but to use revenue. So we need to use the 8 months revenue and then project it to 12 months before you can calculate properly. So we calculated the amortization charge should be 3.8 million. So as I need you to say, this is 8 months. So the 12-month extrapolated number short-month estimated revenue will be 198 divided by 8 multiplied by 12. Okay. Because at planning stage we use projection number to help us to decide materiality. So this is allowed. So once you do that, then you take the amortization charge 3.8, then divide by this number. X. So you divide by X. Okay. So then you should get something about 1 point. So this one is not X. I got the number, so I put in the number. This is equal to 297. So this is 297. Okay? So you get about 1.3% of the 6-month amortization charge, and this is actually less than 5%, less than 0.5% of revenue. And you can say that this is immaterial to P&L. So this kind of materiality calculation get you another mark. But you notice this one mark more difficult to earn because you have to calculate correctly using 12-month number, not 8 months number. So therefore, in relation to the amortization, then you talk about the audit risk. There is no amortization. Now the reason is the case study is silent whether they did or not. Okay, so let me show you. The case study just tells you it start using it from 1st of July. It tells you the opening balance at cost. That's all. Okay? Opening balance at cost. So they may or may not amortize. So this gives you the flexibility, audit risk, no amortization. Now if you stop here, again you won't get the full mark. You need to talk about the impact. If there's no amortization, so which account is wrong and which direction? So here we need to say, therefore this will then overstate profit and intangible asset. So we talk about two accounts that are wrong and the direction. So that's how you get full mark. Okay? So that's the second audit risk that we can see from the information given. Now I'm going to go back and then copy the same paragraph. There's one more audit risk from the same paragraph. Just now we focus on the audit risk arising from the amortization. Now the next audit risk is the impairment of the intangible asset. So it comes from the last sentence. Since the network became operational, customer demand has been less than anticipated due to a competitor offering special deals to its existing customer to encourage them not to change provider. So customer demand is less than anticipated, therefore the value in use can be low. Now, so therefore, this customer demand that is no good, you need to highlight in your answer that this is an impairment indicator. Therefore, we need to say that the management should have performed an impairment analysis on the intangible asset. Now, so this allows us to a lot of flexibility to talk about the risk, how the financial statement can be wrong. So for example, one of the risks, management did not do so. Now, and then remember, to score mark, you can't stop here. You need to say therefore which account is wrong, which direction is the error. So if they didn't do the impairment analysis, then impairment loss if any. Okay. After you've done the impairment analysis, there could be loss, there may be no loss. But in case there is an impairment loss, then it will not be recognized because they didn't do it. So then we are able to now say they will overstate the intangible asset and the profit. So that's what I meant. You have to talk about which account is wrong and the direction. Okay, but we can also say that another risk that the management did an impairment analysis. So we can say that this is subjective because it's about assumption on future cash flow. Okay? And this is the right time to bring in the management bias. So the management bias, so this is a listed company, so they need to meet expectation. Okay. So therefore they become too optimistic in the assumption. So as a result, they may overestimate recoverable amount. So as they overstate recoverable amount, they understate impairment loss. Right? Now, so you can talk about this risk. In fact, you can. So this allow you to write a lot to get high marks. You cannot talk about the next risk is that they did not discount to PV. You can also say that they actually use wrong discount rate. So as a result, we get the wrong number. So these are in the notes. These are in the notes. So therefore, the notes are there to help you to have some thinking. Most of the exam student problem is they spend too long to think about it, and that's because they are not familiar with how to use accounting standard. Okay, right. So this, you notice we have about 3 to 4 weeks already. And based on the answer, the marks analysis, we should be able to pass. If we're not yet passed, we should be able to pass quite soon with one more point. So now we look at the next part of the question. Most of the ZCG's mobile phone customer sign a contract under which they pay a fixed amount each month to use ZCG's mobile network. They pay extra if they exceed the agreed data usage and airtime limit. The contract also allow connection to fixed line and internet access using broadband. So, and most contract run 2 to 3 years. For the first time this year, they are adopting IFRS 15 revenue from contract with customer. So here you can talk about 2 risks. Number 1, first time. First time applying a new standard. Number 1 is not familiar, lack experience. So the client management, the accounting team, not familiar with the new standard, lack experience. So therefore, they may apply wrongly. So therefore, the revenue can either be overstated or understated. Okay. So this is what we call the inherent risk arising from here. So this is an easy one to use in exam. Now, so for your coming exam, some of the new standard, accounting standard, I don't know whether examiner use it, is for example the IFRS 16, the lease accounting. So the new lease accounting will replace IAS 17. So same thing, examiner can say that they are first time adopting this. So you can use the same argument. They are not familiar, so can apply wrongly. But more of the marks will come from the IFRS 15 application, the knowledge of the standard. So you need to look at, they have multiple performance obligation. They have one contract, but the contract tells you they need to deliver different goods and services to the client. So you can see here, The contract is fixed amount per month and is over 2 to 3 years. But they need to provide mobile network access. So that's one service. They also provide fixed line access, 2 service, and they also provide broadband connection, so 3 services. So therefore you need to look at the IFRS principle. Okay. So there are multiple services to be delivered in the contract. So this is called the different performance obligations. And they will have the control paths at different point in time. So, and control paths means the customer can direct the use of the asset or obtain the benefit from the service. So that is the meaning of control paths in IFRS 15. So therefore you need to write revenue can only be recognized when the control paths, which is a different point in time. Okay? So there's a risk. Okay? Revenue is not recognized according to when the control pass to the customer. So therefore they may, for example, recognize revenue too early or too late. Okay? Now, so this then overstate, understate revenue. So examiner, that's why I told you in P7, if your accounting standard knowledge is good, then P7 is easy because this is used in question 1, audit risk question, is used in question 3, matter to consider question, and it is used in audit report question. So from the revenue from contract with customers, we can identify 2 audit risks from here. So plus all the earlier one, you notice it actually almost get full mark already. Now, so now we look at the next part of the case study. Okay, in order to expand its broadband business, they started to buy network capacity from third-party companies. So ZCG entered a fixed-term contract to use a specified amount of the seller network capacity, with the seller determining which of the network assets are used by ZCG in supplying network services to the customer. In the first 6 months of 2016, this year, so they purchased 17.8 million of network capacity from a range of customers. From a range of suppliers. Okay. And the contract period is between 12 months to 3 months. So, and the cost has been recognized as an intangible asset. So they recognize the cost already. So they either debit cost, debit intangible asset, credit cash, or debit intangible asset, credit payable. So here is this. Does it qualify as intangible asset? Okay. So therefore, number 1, there must be control. The company must have control over the resource, and number 2, there must be probable future economic benefits. So we need to talk about this accounting standard, and this is in IAS 38, the recognition criteria of intangible asset. Okay. Now, and this part here, the problem is control. Okay. So which part of the story tells you they may not have control over the asset? It says here, the seller determine which asset are used. So therefore this tells you ZCG do not have control over identified asset. So if you do not have control over the identified asset, it cannot be capitalized. So here now the risk is it is wrongly capitalized. So we will overstate intangible asset and profit. Okay. Not necessarily profit, but definitely intangible asset. Okay. So if this amount that they paid, which is 17.8 million, if it's not called intangible asset, then what should it be called? So if you already paid but it cannot be capitalized, and this is for the next 12 to 3 months. So therefore, the 17.8 million payment for next 12 months to 3 years is actually equal to prepayment. So therefore they understate prepayment, they overstate intangible asset. Okay. So that's the impact. So and then we are given the number 17.8, so you can always talk about whether this is material, okay, to get marked. So this is actually 3.3% of TA, and this is actually 6% of the 12-month extrapolated revenue. So remember just now I walked you through how to do the extrapolation. You have to say it's a 12-month extrapolated revenue, and so it's 6% of revenue and 3% of TA. So therefore this is material both to P&L and balance sheet. So material to both P&L and balance sheet. So remember, this kind of materiality calculation, if correctly applied, will give you 1 mark. Okay. So that's an easy mark that you should use. So I hope you see all this discussion heavily depends on your accounting knowledge. So accounting knowledge is no good, the risk question is very easy, difficult to score. So now we look at the next paragraph in the case, internal audit. The examiner asks you to use all the information, therefore include internal audit. So it says here, they have a good internal audit department. They do a lot of work for the management. In terms of internal control assessment, and they have a manager. This manager is a qualified accountant with many years of experience. So far is to tell you this internal audit department looks okay in terms of competence. Okay. So the issue therefore is not there. The issue is something else, which is the next paragraph. We are pleased to report the internal control. This is the latest internal audit report, and it says to the group finance director, we are pleased to report that the internal control are working well. There are no significant changes to the system during the year. As a result of test of control, we uncover only 2 financial irregularity. This is the failure to obtain appropriate authorization approval for senior management expense claim like travel reimbursement. The unsubstantiated claim is 575,000. The other one is inadequate IT access control. So someone can go in the system easily, and there's a payroll fraud of 750,000. Now you can talk about the materiality here, but the issue now, there are two. Number one is these two will then need to help us to say the control risk is high. Okay. Now, so this one, senior management expense claim will lead us to cast doubts on management integrity. So the internal control environment is weak. So is the inherent risk. So that contribute to the control risk. Then the IT password. So therefore there are significant control deficiencies. You can allow fraud to happen. So therefore the control risk has increased. So we need to increase substantive procedures, especially in the payroll audit. So that is the first issue coming out from here. But there's a second issue. The second issue is the way the internal audit report is written. They say that this is they only uncover two. So it seems to them that they are not thinking it's a very serious problem. It may create doubt that we want to rely on their work because they have different kind of threshold. But the focus is in here. Okay. So when you write this, you utilize the information that examiner give. Good enough. So now we look at the last part. This is the figure given, and this is linked to the first paragraph that I told you. Your examiner meant this to be called different segments. So this is a segment reporting that he wants you to focus on. So remember, this is only 8 months number, so you need to come up with a 12-month number over here. Okay? So you can put the number on this side to use in your exam answer. Okay? Now, so you can go home and try the analysis. I'll highlight one of them, which is the Southeast Asia. Okay? So from 30 to 33, it looks like there's a 10% increase, but because this is 8 months, we need to project to 12 months. So once you project to 12 months, you need to take this 33 divided by 8 multiplied by 12. You see the number become 49.5. So 49.5 divide compared to last year. So 49.5 minus 30 divided by last year as a base. The increase will be actually 69% increase. So this is a very significant increase. And you compare this to America. America actually has a drop. And there's a big drop. So therefore, the examiner uses to say the risk is called wrong classification or allocation to the reporting segment. Okay, right. So typically you talk about the revenue increase so much, therefore it's likely to be overstated. Cut no eyes with the examiner because it may not be, unless the case study gives you reason for doing so. Okay? Now, so don't do the general analysis, do this kind of specific analysis. So you can go and add up the number of risks we identified, the number of materiality we calculated, and the trend that we show. We have shown two trends over here. So that is the kind of audit risk answer you should be hoping to do. So please spend some time to read the examiner suggested solution, but the key points are here. So that is the illustration for question 1. So now what we're going to do is to look at another type of question, now called method to consider question. Evidence expected. And evidence expected is similar to audit procedure. Audit procedure is a procedure we perform to get the evidence. So therefore, they are about the same. Now, when in the exam, the examiner like to put this in the question this way. This is the planning stage. So the most important question here is the risk questions. We already cover. Then this is the testing stage, and here the question is usually called audit procedures. The P7 question will not ask you test or control is what, substantive procedure is what. The examiner just asks you, there's this problem, what are the audit procedure you perform. Then we have the next stage. This is called the review stage, and then we have the next stage called the reporting stage. So this is in question 5, audit report, and this review stage is always manager review file. Therefore, what should he consider? Matters to consider. And he's reviewing file, what kind of evidence he expect to see in the working paper. So it's called evidence expected. So the examiner is actually using this as a background of this kind of question. So there's an answer format. Method to consider. Minimum you should be able to get 3 marks to 4 marks in the exam. What you need to write in the exam answer is to demonstrate to examiner, as a manager, I look at the issue, I consider whether the materiality of the issue. Is the issue material or not? That's number 1. Number 2, the issue here, how should it be accounted for properly? What is the relevant accounting standard? What is the correct accounting treatment? And therefore, what is the risk of misstatement? So therefore, if you follow this format, minimum you can get 3 to 4 marks. And remember, P7 examiner used the following threshold. It is not fixed according to auditing standard, but it's your examiner's practice. If the problem is equal to higher than 0.5% of revenue, or 1% of total asset, or 5% of profit, is considered material. Less than that is called immaterial. But so long as one of them is higher, is material. And she prefer you to be precise in calculating materiality. So for asset and liability, we use total asset. For P&L, we can use profit or revenue. Okay? Now, the evidence expected is actually what should be the evidence to prove compliance with FRS. So it can be to prove something exists. We can look at the document or asset. Okay, prove the amount is correct, we can look at the document like invoice. To prove the transaction has occurred, we can look at the document. Okay? So after that, we prove they meet the criteria in NFS. We prove they follow the accounting standard in FRS measurement. So this is the evidence. So I'm going to use one very simple concept to illustrate. Then after that, we're going to see question. So for example, the asset held for sale. So our recognition criteria, number 1 is management is committed. So the evidence we need to prove this criteria is met, what will be the evidence? That will be the board minutes. So we want to see approval. Okay? The reason is quite simple. If the board has not approved to sell this fixed asset, they cannot be committed. So that is the minimum evidence we need. So you notice, by doing this, I do not have to memorize audit procedure or the evidence when I go for examination. I use the accounting standard to help me to come up with the evidence. And the second criteria is that the active program to sell. They started selling, so we can look at the agent contract instruction. So if it's a property, then the management has appointed an agent. If they're not appointed, they can't be active. Or for other asset, we can look at the advertisement that the management took out to try to sell the asset. So this would be the evidence to confirm that this criteria can be met as well. And then the third one is called available for immediate sale. That means this asset is not in use. So therefore we do a physical inspection. So is it available for immediate sale? So that will help us to come up with the fourth evidence. Then the next one is actually it is likely to be sold within a year. So how do we know this is likely to be sold within a year? We can look at the correspondence with potential buyers. So from the correspondence, we can see how close they are in closing this deal and see is it likely to happen within a year. So you notice the audit evidence linked to the accounting standard, and all these are called the recognition criteria. But remember, we also have the measurement. So once you met the criteria as held for sale, what is the measurement? So remember, lower or net book value and fair value less cost to sell. So net book value, we do this. We agree to non-current asset register. Confirm the net book value is correct. Now fair value less cost to sell, we can look at the, for example, valuation report if this is a building. Right? Now, so let's call measurement. Now, and then remember, they are supposed to cease depreciation. So what evidence can we expect to see that they actually cease depreciation? We can actually recalculate the depreciation. So make sure they stop depreciating when they classify as held for sale. So if you can follow this approach, then you notice the amount of things that you have to memorize for exam will cut down significantly. You can design the procedure based on the case study. Right? Now we're going to illustrate using an exam question. Okay, this is a March and June 2017 exam question, question 4. I'm only looking at question 4b, the impairment area. So before we look at the case, you look at the requirement. So the requirement is part 1, matter to consider, evidence expected. Okay? Now, so therefore, if you look at the mark allocation, it's 7 marks. Now the examiner did not say part 1, matter to consider, how many marks, part 2, evidence expected, how many marks. So but 7 you can see here, okay? You can do about 3 to 4 from matters, and then 3 to 4 from evidence. Okay? So therefore we do not really need to write about 10 evidence, 20 evidence. 3 to 4 sufficient for exam purpose. And the matter 3 to 4, if you follow what I mentioned, is it material? What is the correct accounting treatment? So what is the risk or actual error? You can at least write 3 marks from there. Okay? So it's sufficient for answering this kind of question. So now we look at how to apply this format. First paragraph. You are the manager responsible for the audit of OCA. It's a jewelry manufacturer retailer. Year end 31st of March 2017. You are completing, you see, nearly complete. That's why the manager come and reviewing the file. The manager is reviewing the file. We are given this number: total asset 1919 million, revenue 1052 million, and profit before tax 107 million. These are there for you to calculate materiality. So we focus on the B, impairment. Now, so for B, impairment, at the end, year end, management perform an impairment review on its retail outlet. So all the retail outlet is one cash generating unit. Okay, and the reason why they do that is because as an impairment indicator, because of the internet sales grew rapidly, the sales from retail outlet declined, prompting the review. So this part you can comment, it's actually consistent with the IAS 36. Okay? At March 31st, so remember March 31st, look at the year end, March. So in exam just write this is at year end. So at year end, the book value of the asset in the retail outlet total is 137 million, and this include tangible asset and goodwill allocated. Okay, now, so therefore from here straight away see whether this is material. So this is the asset which is tangible and goodwill. So divide by total asset 1919 million. So then you comment, is it material? Now, so the next part, we look at the information below. During a year, management received a number of offers from party interested to buy the retail outlet for average of 125 million. So you can see the book value is 137. So this one tell you the fair value is actually less than the net book value. Okay. Now, so, and this is the disposal cost. So what it tells us here is the fair value less cost to sell will be 125 minus 115. So 123.5 million. So that's called the fair value less cost to sell. Okay. The management estimate the value in use to be 128. This is using the historical cash flow at 1% inflation rate per annum. Okay, so therefore you use this to calculate. Now, and then what happened next? Is they use this to determine the impairment loss. So this is 9 million. To restate them to the recoverable of 128 million. Okay. Now, so in this case here, they actually follow IAS 36. So you can talk about IAS 36, the drop in sales equal to an impairment condition. So therefore it is correct that management perform an impairment review. So you need to say that recoverable amount equal to the higher of fair value less cost to sell and value in use. Okay. So therefore, which is equal to 128. Okay. So management actually applied the formula correctly. So you can mention this in the exam. But what is wrong is this: the value in use is actually predicting future cash inflow. Okay. So therefore, we are using assumption about future cash inflow, and the assumption is the historical growth rate plus an inflation adjustment of 1%. So therefore, we need to say that this is too optimistic, and therefore this will overstate value in use. Okay. Now, to show the examiner, you don't anyhow come up with the accusation that they overstate the growth rate. We use number to show. Okay. So the more you can use evidence, the stronger your answer will be. So where is the evidence? They don't have growth. They actually have negative. So you can see here the revenue is 1052 million, and the other one is 997, that is last year. So there's an increase, but they say that this increase is the retail sale drop and the online sale increase. So retail sale actually has negative growth. So if the retail sale has negative growth, then we cannot use retail sale and do add 1% inflation, and we are projecting positive growth. Okay? So therefore, the projecting positive growth is therefore wrong assumption. Okay, right? So this is the first misstatement we are given. So the impairment loss could be higher than the 9 million that they use. Is it okay? Right? Now, so you can also talk about whether the 9 million is material by dividing that with the profit figure. So the profit figure given to us is 107. So we look at 107 million. Okay. Then you say that this is 8.4% of profit. So it is material. So the impairment loss is likely to be bigger than that, so definitely is material. So here we are using the information up to the assumption. Now the last part is the allocation of the impairment loss. So here it says because they calculated the impairment loss is 9 million, so they write down the asset. How they write down is first they write down the tangible asset on pro rata basis. So therefore you need to say this is actually breach IAS 36. IAS 36 is first is to allocate impairment loss to goodwill. Then allocate to the asset on the pro rata basis. So you need to then highlight here now is they will then overstate goodwill and understate other asset under said the tangible asset. Now we are not given how much is a goodwill, so we don't know how much has been overstated, understated, right? Okay. Now, so this will be the impairment. So the analysis, the evidence, will be get the impairment analysis. We look at the historical rate. We agree to the net book value. So just write 2 or 3. That will do. So for example, using the information from the story, we need to obtain management impairment analysis. So always do the recalculate to ensure accuracy, no calculation error. So remember, we write 3 to 4 sufficient for exam. Next one, they have a fair value, and the fair value they actually obtain from the interested party quotation. So therefore, we can actually review correspondences with potential buyer to confirm the value is about 125 million. Okay? Right. Then we can actually review the assumptions in value in use. So we can look at the historical growth rate and things like that. Now you can also write one more thing, which is discuss with management how they estimate the cost of disposal. Then we go and obtain evidence to prove this is correct. So just write about 3 to 4, but you notice I focus on the case: value in use evidence, value for sale evidence, and recalculation of the spreadsheet. So with this, it's very easy to get the 3 marks necessary. Okay, so that's the second most popular exam question in an exam, method to consider. Every time method to consider come out, it will be about 3 area. So each area about this kind of mark, 7 mark. So therefore 3 area is about 21 mark. And remember, question 3, 4, 5 is 20 mark. So that's the mark allocation. Okay, so now we come to the last type of question to go through review. This one here is the audit report question that always come out in question 5. Now, so you must remember, if the examiner mentioned unmodified, means in auditor's opinion FS are true and fair. Modified report means the unmodified report, the standard report has been modified. It can be because of any of the following situation. 1. Auditor change your opinion from unqualified to qualified or adverse or disclaimer, or the auditor add a paragraph called material uncertainty related to going concern, or the auditor add a paragraph called emphasis on matter, or a paragraph called other matter, or a paragraph called other information section. So now, so when can auditor issue true and fair? There must be of sufficient appropriate evidence, and there must be no material misstatement. So any misstatements are immaterial using this threshold that we went through earlier on, right? Now, so therefore, modified opinion, when do we issue which type of modified opinion? Now, if there's a misstatement and it's material but not pervasive, qualified. Or limitation. Limitation means auditor cannot get the evidence, so, and it's material but not pervasive, qualified. So actually qualified means except for this area, the FS are okay. Now adverse is only used in misstatement when the misstatement is material and pervasive, so the whole FS are wrong. So auditor say FS are not true and fair. Disclaimer is only used when there's a limitation, auditor couldn't get evidence, and the whole financial statement is affected, so it's material and pervasive. Now, there's nothing to memorize here. In exam, it's all case study driven. You need to first look at the case study and say, what is the problem in the case? Is it a misstatement or a limitation? So you have to decide correctly first, number one. Number two, is it material? Because this is not material, it doesn't affect audit opinion. So if it's material, then number three, is it pervasive? So you can have not pervasive or pervasive. Then based on that, come up with the correct opinion. So you need to have this kind of thinking process. Now once you get the front wrong, then your back will be wrong, right? So it's important to get it right. Now, so material, we know how to decide. We use those financial threshold to decide. Pervasive, how to decide. Now pervasive, according to the standard, means the problem affect substantial proportion of the financial statement. What is substantial? Now, so in the P7 exam question, if the company is not a going concern, they should not use going concern basis to prepare FS. So if the case study say they still do that, then it is material and pervasive misstatement. Okay. Second one is there are many misstatements and all these individually are very material. Then majority of the FS is wrong. Then it is called pervasive, or the error caused very misleading information, misleading impression. For example, they actually should have a reported loss or a small profit, but the misstatement result them in reporting significant profit. So this resulted in the FS being totally misleading, is also called pervasive. Now I give you one more example for pervasive misstatement. So, for example, the investment in financial instruments are overstated. The amount overstated equal to 60% of total asset. So here we can have one misstatement, one figure that's wrong, but 60% of total asset would then be called substantial proportion of the FS. So this is a substantial proportion of FS, and therefore this amount stated will become a misleading SFP. So it causes a statement of financial position to be misleading. Then this kind of problem, we will call that a pervasive misstatement. So material pervasive is decided in this way, right? Now, so for limitation, material pervasive limitation means most of the account we couldn't get evidence. For example, most accounting records are destroyed by fire. So we call that a material pervasive limitation. We cannot give opinion on the FS. So you have to decide correctly. Now, so I'm going to illustrate using this kind of exam question called criticize audit report. Now, in this kind of question, the examiner will give you a sample or a draft audit report, but she will not give you the whole report. She will give you a certain paragraph. Usually the paragraph is the opinion paragraph, the basis paragraph, and the EOM paragraph. So first thing you need to do is look at the paragraph sequence. Is it correct? Now in order to do that, you must know the correct sequence. So I'm going to walk you through the correct sequence now. So the correct sequence. Now the standard divide between listed company, audit report, and private company, not listed company, audit report. The difference is this paragraph called key audit matters. But number 1 is title, number 2 is addressee. So these are the same sequence. And I actually copied into the wrong place. So let me delete this and then redo it at a fresh page. So we have the listed company, and private company. So number 1 is title, number 2 is addressee, and these are usually not important in the exam. The examiner won't put this in the report for you to criticize. But number 3 now, based on the latest standard, the standard audit report must first come with opinion. Then number 4 is the basis for opinion. So the basis for opinion actually now is below opinion. That's the new standard. Then number 5 is key audit matter. This is only for listed company. And this is not applicable to non-listed company. Okay? Now, and then number 6, then we may have, for example, EOM. Then we may have OM. Then we have the OI. Okay? Now, if you need to highlight going concern problem, then the going concern problem is here. It will be before KAM. So that's called the material uncertainty related to going concern. Okay. So that's the correct sequence. So in exam, when the examiner asks you to critically appraise a report, one of the easiest one to get marked is the sequence is wrong. So we need to rearrange the sequence. Alright, now, so we'll see that in the question later on. The second thing we need to look at is each paragraph should have a correct heading, so whether the heading is correct. After you finish with this easy mark, then we look at the basis for opinion. Usually they need to explain the problem, so we look at whether the explanation is clear. Now, to be clear explanation, they must highlight which account has problem, and the name must be specific, so they cannot just mention intangible asset. They have to say capitalized development expenditure, so that we know is that particular intangible asset. We must state the balance in the account, and if it's a misstatement, we need to explain why it is a misstatement. If necessary, quote the standard that they didn't follow. If it's a limitation, we have to explain how the limitation arrives. For example, management disallow the auditor to attend stock count, so we have to explain that. So we have to quantify the misstatement and talk about the impact on profit, impact on asset or equity. If you have all of this, it's called good explanation. So in exam, the explanation will be lacking in this kind of detail. You need to point them out. Then we look at the language used. The examiner say no unprofessional language. So I'll show you what's called unprofessional language. Then finally, then we talk about whether the opinion they give, is it right or wrong. So if you follow this, it's very easy to write about 6-7 problems. Okay? So there's always very easy to score mark. So now we look at this question. So this is a September-December 2015 question 5A. So you can see we are given 10 marks here to critically appraise the draft audit report. So what's wrong with this report? Okay. You are the audit manager at Rockwell. You are responsible for the audit of Hoppo Group. This is a listed client. They supply ingredient to the food and beverage industry worldwide. The year end you are looking at is 30th June of 2015. The audit is about to complete, and you are now looking at the draft audit report prepared by the senior. During the year, they bought a new subsidiary. The new subsidiary is called Surarat Sweeteners Company. They have expertise in research and design of sugar alternatives. So we are given the number. The number is profit before tax 495, and last year 462. Total asset 4,617 million. So now we have part of the audit report draft, only part of it. So we are given the basis for modified opinion and then the emphasis on matter. Now in exam, always look at the emphasis on matter last. Okay? Look at the front first. So I'm going to copy out the front and then use what I just mentioned to you. Look at audit report using number 1, is the sequence correct? Number 2, is the heading correct? Number 3, is the explanation clear? Number 4, is the language okay? Number 5, is the opinion correct? So we look at here, basis for modified opinion. In the calculation of goodwill on the acquisition of new subsidiary, the directors fail to recognize consideration which is contingent upon meeting certain development target. The director believed this is unlikely that they meet the target, therefore did not record the contingent consideration in the cost of acquisition. They have disclosed this contingent liability fully in the note. We do not feel that the director treatment is correct. Therefore, we do not believe the criteria of the relevant standard have been met. If this is the case, it would be appropriate to adjust the goodwill balance in the balance sheet. We believe any subsequent adjustment may materially affect goodwill balance in the balance sheet. Therefore, in our opinion, the financial statement do not give a true and fair view of the balance sheet and the financial performance and the cash flow according to IFRS. So actually, this part here is called basis, and this is the opinion. Okay? So therefore, they should switch sequence. Now, the suggested solution will not say that because it's the old standard. So first one is the opinion para. Should be before. The basis for opinion para. So this is a very easy mark to get, right? Now, second, heading. So for heading, you need to see what kind of opinion they give. They say FS do not give a true and fair view. So you need to highlight this. The proposed opinion is an adverse opinion. So the opinion para should have a heading entitled adverse opinion. So this is the easy one, but then the third one is here. Then this is wrong. Basis for modified opinion should be changed to basis for adverse opinion. So this is our third comment. Okay. Right. So we have 1, 2, 3 done. And this is the easy mark. That's why I like you to follow this sequence. It's very systematic, structured, and very easy to get the mark out early. So usually student problem come to question 5, they run out of time. Right? So when you run out of time, you cannot write something complicated. So you do the easy one. Okay? Now, so after that, we look at the explanation of the basis paragraph. So it says here, goodwill. The problem is goodwill, but they didn't mention how much is a goodwill in the balance sheet. So that's number 4. 4 is they did not state the amount of goodwill in the SLP. So the shareholder have no idea how big a problem are they looking at. So that's why this report is less useful, right? So that's the number 4. Then we look at the next part. In the acquisition of new subsidiary, so that's number 5. So they did not name the subsidiary. We know exactly it's Suarez Sweetener, but now shareholder may have no idea which subsidiary are you talking about, especially if they have a lot of subsidiaries. Okay? So it will be more useful if you can state which subsidiary for the shareholder to see. Now, so that's number 5. And you notice now you pass already. These are the easy one. Then next, they fail to recognize contingent consideration. Okay? So therefore, it says we do not believe the criteria of relevant standard have been met. So that's number 6. Okay. They didn't recognize contingent consideration is a misstatement. But why is it a misstatement? Okay. So did not state the IFRS, IAS that was breached by not recognizing contingent consideration. So that's the number 6. Now, if possible, if you remember, then say which is the standard. So you might want to talk about the IFRS 3 business combination require contingent consideration to be recognized at fair value. Right? So your answer will be pretty substantial. So that's number 6. Now number 7 is they didn't quantify how much is this contingent consideration. They only say that they need to adjust goodwill, but they didn't say how much is the adjustment. So we don't know how big the error is. So that's number 7. So therefore, they did not quantify. So number 1 is the amount of contingent consideration. Number 2 is the goodwill to be written off, goodwill to be adjusted. So they didn't quantify impact on asset and profit. Okay. So that's number 7. So notice up to here is still a very easy way to tackle this question. Now we look at the next part. Is unprofessional language. Okay. So it says here, we do not feel that the director treatment is correct. This is our number 8. Do not feel is called unprofessional language by your examiner. You can see the suggested solution, the examiner used the word unprofessional. Okay? So do not feel, we need to state clearly it is a mistake. So this doesn't convey the clarity of the problem. So that's number 8. Then there's another one called unprofessional language here, which is this part. Number 9. If this is the case, the problem is the word if. Then the word if here implies auditor is unsure. What is the correct accounting treatment? So that is bad. So that's our number 9. Now we look at the next part. Lastly, then we look at the figure called the opinion, true and fair. Now in this case here, unfortunately, the numbers are not given, so we are not able to compute is it material and is it pervasive. But you need to say, do not give and true and fair must be only given when there's a misstatements are both material and pervasive. You can only do that in this case, in the case where misstatements are both material and pervasive. Now the number of goodwill is not given, but it is unlikely goodwill misstatement alone is both material and pervasive. So the opinion they give is a bit too strong, so therefore you say maybe a more appropriate opinion will be equal to the qualified opinion. Okay. Now, so when you are able to do that, you notice this is our number 10 already. Now, the examiner does not give you 1.1 mark, it actually give you about 1.5 mark for each. I already get full mark long time ago, right? Now, so you pass even much earlier into the case. So these are showing you there are a lot of information you can use. Now, the last part now, then we come to the EOM. So the EOM is to say whether the EOM is correct. So here, we draw your attention to the note that describe the uncertainty relating to the contingent consideration. So therefore, this is called wrong EOM. That's the last one. So that's number 11, called wrong EOM, should be removed. But you need to explain to the examiner why this is wrong EOM. So you say EOM can only be used to highlight a FS matter that is fundamentally important This is the first criteria. It is fundamentally important, but there's a second criteria, and the second criteria is and it is appropriately accounted for, disclosed. That means the accounting is correct. So there are two criteria. Number one, it is very important for shareholder to know. Number two, the accounting is correct. Therefore, I don't qualify them, but I need to then highlight using EOM. Now, in this case here, it is wrong to EOM. Why? In this case, the goodwill is materially misstated. So it is not correctly accounted for. That is not correctly accounted for. So we cannot EOM. Okay? Therefore, not appropriate to EOM. That's why we need to remove EOM. So this is the last point we do in the question. So you follow the systematic approach that I tell you, then go through one by one. It's very easy to get full marks. Okay? So that's the audit report question. So I have come to the end of the P7 important questions, how to tackle this and how to get full mark. So I hope this is useful for you. So now I'm going to pause and then wait, see whether you have any question for me. So I'll wait for you to 1-2 minutes to type the question. If not, we'll do that, we'll end it. Now there's a question here about the written note, whether you're going to receive this written note later. The answer is yes. I'll save it, and then this will be then forward to ACCA in Australia, so you should be able to get it from there. Okay, so that's the first question. There's another question. It says here, for audit report, we have to use the new standard. The answer is yes. It is the new standards actually is effective from the September 2016 exam. So the new ISA on audit report is actually effective from September 2016 exam. Okay, so there's a new ISA called ISA 701 KN. Okay, then the ISA 570 is about the going concern. So that one talk about the material uncertainty related to going concern. So that's, if you go to the technical article by examiner on ISA, on new ISA on audit report, the examiner wrote it before the 2016 exam, so you can go and see all this relevant information in there. Okay, Maggie, you're welcome. I hope that's clear for you. Okay, there's another question. Which question we should do first? This one, different student and different style. Now personally, I will do question 1 first. The reason is because especially like in Singapore, my students, they practice question 1 risk question extremely well because we know it will come out. So therefore they find it very efficient to deal with question 1, and it's mandatory. But it doesn't mean that they complete question 1 before they move on to other question. They are only strong in the risk part. So you notice the risk part is only part A. Then we have part B called ethics, part C called substantive procedures or audit procedure. If they are not too sure, they just keep 1-2 page empty and then they move on to the next question. And usually, personally, I'll recommend if you are strong in, for example, the accounting standards, the method to consider question is very easy to tackle because there's a standard answer format, materiality, relevant accounting standard, then the risk. So you might want to do that as a second question, and then the next one will be audit report question. But the non-audit usually are tougher because it is less common for students to come into non-audit like KPI audit, forecast assurance, or forensic in our real life. So if this is optional, usually we try to tackle that last. Since we've got nothing much to write, right? So you spend too much time thinking, you're also writing not much anyway. So I recommend audit risk question, method to consider question, and the audit report question first. That's my recommendation. Maggie, thank you for the question, and you're welcome. So we'll keep this alive for another next 2 minutes. So if you have any questions, please quickly type it, and then let me see in the next 2 minutes, and if not, we'll call this to a close. Which accounting standard is most likely to be in the coming exam? Now, all the accounting standard except the one that just came out in the last exam. So it is not really accounting standard. Remember the last exam, what came out was decommissioning. So therefore, decommissioning less likely. The last exam we have the useful life change in accounting estimate. So therefore, that is less likely. And then we have the last exam called provision for bad debt. So these are less likely. But then every other thing has a chance, like the accounting for government grant, the impairment that I walked you through, the non-current asset held for sale, the FRS 115 that we did just now. All this has a possibility. Now, in terms of the non-assurance topic, remember I told you due diligence just came out. So therefore, for the non-assurance, non-audit services, so therefore you should focus on the PFI, and number 2 is the KPI, or Performance Information Assurance. So these two will be more likely, and the PFI will be forecast. So it can be forecast cash flow, which is the most common in exam, but it can be forecast P&L, it can be forecast balance sheet. But I recommend you spend more time going through the past paper on forecast cash flow this time. Right, okay. Now the question about some important tips is the ethics always will be examined. So you need to know, you need to be able to identify which threat. You need to talk about, is the threat significant? Then you need to talk about how to manage. And how to manage, you must remember to quote the code. So code. So now the code is called the IES BA code. Okay. So according to the code, we should assign another partner to take over to avoid this risk. So and you need to talk about, is it significant? So for example, if it's a self-interest threat due to overdue fee. Now overdue fee just came out, so slightly, but you need to say how much is it overdue. Is it a lot? Then if it's a lot, then it will be significant threat. Same thing here, if you talk about self-review threat, then you say the self-review threat comes from me providing accounting. But what kind of accounting am I providing to you? So if I'm only doing the petty cash accounting, then it's actually immaterial to the FS. So when I audit that, there's a self-review threat, yes, but it will not be significant. But if I handle the whole set of book for you, then I audit the whole set of book that I prepare, then the self-review threat will be extremely significant. So in P7, if you are able to discuss this kind of significance, then your answer will be substantial. Okay, so that's the tips for the ethical threat. Ethical threat will always come out in exam. IAS 12 for income tax. Now for IAS 12 income tax, you actually can see my notes that I provided. So I refer you to the page. That's why I provide this for you. So you can see in number 5, this is IAS 12 income tax. The exam question in P7 is always about deferred tax liability or deferred tax asset. Now, and then deferred tax liability, they should always recognize deferred tax liability when there's a taxable timing difference. Okay? And the taxable timing difference is called taxable temporary differences. So the risk is always they are not recognized. Now, for deferred tax asset, which is more popular by the examiner, is because deferred tax asset cannot always be recognized. You must have something called probable future taxable profit to utilize a deferred tax asset. To utilize it, then you can recognize. If not, you should not recognize. And we don't. So the company have been making losses. We are supposed to look at the forecast for the next few years. Are they likely to have sufficient future profit? So if not, they shouldn't recognize. So the risk is always they recognize it when they don't have, they cannot predict future sufficient profit. They overstate deferred tax asset. So this is the one that is really important for P7. Now the next question, do we need to really write too much? I'm very slow in my writing. So you look at today what I wrote, is that called too much? Now if you want to write that the suggested solution is impossible, I have students who try to just copy the suggested solution. It will be more than 3 hours if you copy. So but if you can handle like the way I handle, and then the most important points are there, it should be sufficient. Okay? Now if you are slow in writing, then I recommend, number one, of course, you try to write a bit faster. But number two, that means you have to spend less time analyzing. You need to make sure your analysis is fast to make up for your weakness. So the answer format that I told you, like number one, is it material? Number two, what is relevant accounting standard? Will speed up your writing because you don't have to think about what to write. This is the thinking process you follow. Like audit report, what is the issue? Is it misstatement? Is it limitation? Is it material? Therefore, what is your opinion? If you follow this, it will speed up your thinking process as well. Okay? So I hope this will be helpful for Imran. Okay, Imran, you're welcome. Thanks for your kind words. We will let the clock run for a minute. If there's no more question, then we close it. The question is whether this recording is going to be available. Yes, it is recorded, and then it should be available on the YouTube channel. What channel? The YouTube channel is going to store this, so you can look for it. It's under LSBF ACCA live stream. Okay? So you can find this in the YouTube. Now the next question is how many paper sample we should practice before exam. Now if you have the time, then you can practice 10-year series, but obviously we don't have the time. So minimum try December 2014 onwards. And the reason is try the recent one. There's a change in the examination team, as I mentioned. So the style sometimes a bit different. And be careful when you use the suggested solution. Some of the suggested solution, like the one before September 2016 exam, is using the older auditing standard on the report. Okay? So the answer may not be that relevant. So just be careful. So start from December 2014. Work all the way through to the June 2017. Maggie, welcome. You like the audit risk question analysis and the audit report question. That's good. So it looks like you didn't quite like the method to consider part. So when you look at the audit report, just remember there's one past year paper, recent one, that is one company with 3 misstatements. So you're required to look at each individual misstatement, then after that evaluate that in aggregate basis. Okay? So that question is complicated, but if you look at the suggested solution, it's very structured, and this is possible to come up with the ISA 450 together. So the 450 will be the 5A, and that question can be 5B. Okay. Yes, Imran, I hope your confidence is justified. I believe you will, because most of my students did very well in P7. So I hope you will too. Good luck to you. Alright, so there's no more question. So thank you very much for taking your Sunday off to attend this webinar. I really hope that you have invested well in your time. So just keep practice, and I believe all will do well in the coming exam. So good luck and have a nice weekend. I'll say goodbye here. Bye bye.